Obama's got a brand new budget, and Jeff Immelt is buying a whole lot of stock. You're in the right place, folks, because this is where the money is. Welcome to the show. I'm Matt Koppenheffer. This is David Hanson. David, the voters of D.C. have just voted to decriminalize possession of marijuana. Are you making plans to move from Virginia to D.C.?
No. Taxes are higher in D.C. I can't move across there.
Yes.
I afford them like you.
Yes, but taxes, but you
get the benefit.
I know you've got just like those stockpiles of that stockpile of marijuana that you're waiting to be able to use.
It's growing. I got a nice sunroom, a greenhouse in my apartment.
So you're not moving to D.C.?
Nah, sorry.
All right. Moving on to the first headline. First headline of the day comes from the Wall Street Journal. 2015 budget. This year, taxing Wall Street is bipartisan. So David, we've got President Obama's new budget, $3.9 trillion, if I've got that number right, give or take.
Whatever.
A couple $100 billion, who cares? The highlight for us, for this show, is the fact that Obama's budget includes the financial crisis responsibility fee, and this mirrors, not in name, but it mirrors what the Republicans were doing in their budget proposal, basically saying we're gonna tax the biggest banks, we're gonna make them pay extra taxes. As the headline says, this appears to be bipartisan. You can't get both sides to agree on almost anything, but you can get them to agree on we're going to tax banks more.
Yes, and I'm not sure if it'll pass. Do you think it'll pass? First of all,
Obama's budget.
Or kind of just this tax. Do you think this tax will be an actual thing?
I don't know. A budget's got to pass, and both sides hate each other so much. I don't know whether that's going to happen.
My first thought was...
But yes, I mean, I think you can get agreement on that.
My first thought was, I don't care, and this is just a small tax. But I thought about it more, and I think it is somewhat of a big deal here when you're especially talking about the big players, and if it's a tax on assets over a certain threshold, that's actual money that's flowing to shareholders. And over the last couple of years, as valuations have been below historical norms, people have said, well, it's below, it's because there's uncertainty about profitability coming back. And we've kind of said, yeah, that's not a big deal, it'll come back. But these incremental hits do make a difference in the long run, whether it be a return on equity of 12% or 11%. That doesn't sound like a lot, but it can add up over years. So I am starting to think maybe valuations do deserve to be below historical norms because of these new regulations.
Wow, that's a...
I'm turning a page, I think.
Wow, that's a really... How much below historical norms? Because, I mean, they're significant, depending on what you consider historical norms to be, they're significantly below historical norms.
Well, when you look at just the tax, it doesn't seem like a huge thing, but these incremental changes take a hit. You look at the Volcker rule. We say it's not a huge deal, but that's incremental.
Well, okay,
costs.
let's take it this. So you bring up the Volcker rule. So it's the Volcker rule. It's this tax which targets the biggest banks. So is this an argument to say, skip out on the J.P. Morgans of the world? Look at these smaller banks that don't have that kind of asset, that kind of balance sheet that's going to attract these kind of hits.
No, because I still think the valuation's attractive, despite the fact that they're not going to turn there. But I'm saying the incremental stuff, it does add up when you think about it. The tax, the Volcker rule, the Card Act, you look at interchange regulation, that's all revenue or cost that's coming into the system. So it does make a difference.
Well,
I'm not going to be naive
when you consider that a lot of that has already gone into effect.
Yes.
And with that in effect, JP Morgan is still saying we're going to earn 15% on our equity this year.
Right, and I still think multiples can move up, but this is the argument to say that multiples are not going to go to 2005, 2006 levels. That's what I'm saying.
Okay, back to the tax, just to wrap up. I don't think that this makes sense other than it's good politics. This gets money to the government, and it hits a group that nobody's going to get up in arms about. If you say we're going to tax banks more, nobody's going to say, oh no, don't do that.
Well, the banks will.
The banks will,
yeah.
But they don't have much credibility right now.
True.
Second headline.
Well, we have a second headline of the first headline.
Oh, that's right.
Sticking with the budget, we had a financial regulator calls Obama budget woefully insufficient. This is the Commodity Futures Trading Commission, and they got a budget of, what was it, 280 million?
Yep, which was
saying this is nowhere near what we need.
It was actually up not an insignificant amount from the previous budget for the CFTC, but the CFTC has an expanded oversight now. And I think, you know, what's interesting to look at, now we don't want to say that regulators need to have the same budget as the companies that they're regulating, But at Goldman Sachs, and remember, the budget for the CFTC, and this is one of a number of regulators, but the budget of CFTC, that's salaries, that's benefits, but then that's also all the operating costs. Salaries and benefits alone at Goldman Sachs were $12.6 billion in 2013. $12.6 billion.
Yes, yes.
And the
Much
budget
smaller.
and the budget for the CFTC is $280 million. I mean, you are talking like in terms of firepower. This is like I don't know, some small township going up against the entire United States.
I think this is more politics as well. It's a
I hope the
regulator,
CFTC is reading Malcolm Gladwell's book, David and Goliath, because that's the battle that they're fighting. That's the battle that the regulators
Have you considered maybe they're just saying they're covering themselves a little bit in case something blows up? People point to them and say, you should have done something about this. Well, we asked for more money, and they didn't give it to us, so maybe this is politics as well.
Everything's politics, David.
I like that.
I'll let you read the actual second headline.
All right, actual second headline from the Wall Street Journal. Moelis IPO filing shows rise of small advisors. So we have Moelis going public here, joining the ranks of the public independent investment banks, Evercore, Greenhill, Lazard. Interested?
This firm was just founded in 2007.
Yeah.
It's basically a bunch of guys, most of whom worked together at DLJ up until Donald Lufkin Genretti, back until 2000. Left to go to UBS, worked at UBS until 2007, and then all jumped ship to found Moelis. This company, since 2007, has done some absolutely monster deals. Monster deals. So there's definitely credibility here. But my question is, to myself, under what circumstances do you buy a standalone investment bank? And for an upstart like this, right now, this is all on Moelis himself. This is all on the CEO. So right now, you're buying basically a piece of him.
Because he's amazing. I mean, in the world of investment bankers,
kind of a big deal.
Don't want to put them all on pedestals here, but this guy is a quote-unquote rainmaker.
Not quote-unquote. He just is
Yeah.
a rainmaker. But you're basically buying a piece of him, sort of like when Evercore went public, you were buying into Altman.
Yeah.
Right? Although Altman, maybe when they started Evercore, was smart about the fact that he didn't name it Altman Securities or something like that. So I think if you're investing in Moelis right now, the company, the bet is that they can turn what's basically just him into a brand. If that becomes a brand and it can survive without him being at the helm anymore, without him making it rain, then maybe this is a good bet.
I think it says something about the time they're going public as well. They must think this is an opportune time for some of these partners to be able to cash out when you look at the multiples of the overall stock market and of that particular.
Well, the multiples of the standalone investment banks of Evercore, of Greenhill,
pricey
attractive.
maybe. You could say they're justified, and I've said they're justified by how they're growing, but in terms of the enthusiasm for that, enthusiasm for this niche market, it seems like a good time for them to go public, so can't fault them there.
Not necessarily, I don't think, I'd be careful, let me put it that way, I'd be careful about saying, well, this is the tipping point, this is where everything's going to go downhill, because when we go back to when the PE shops started to go public, Fortress, I believe, was really the first one, and it wasn't until a ways after that everything started to kind of unwind. But at the same time, we did see that process play out until the point where Blackstone went public, got a tremendous valuation, and then cratered.
Yeah.
So if this continues, if we continue to see banks, securities firms, maybe more independent M&A shops go public, keep an eye out. Be careful.
So it sounds like you're not too interested, not really putting it on your radar. I'm gonna put it on my radar. I think it's an interesting. You don't like the business model as much, but I like the business model of the standalone investment bank. So I'm putting it on my radar.
Well, we'll look forward to hearing more about it.
All right.
It's not on my radar, but we'll look forward to hearing more about it.
More for me.
Third headline. This one comes from Dealbook. Immelt spends his cash bonus on GE stock. By the way, is Jeff Immelt looking like he put on a few pounds? I mean, I don't mean to go there, but he does. He kind of looks a little bit bigger than the last.
Hey, if you make that money, you can eat.
I guess so. So we don't talk about GE a lot, but I feel like we can talk about it a little bit because it's got the big GE capital arm that may be hitting the public markets pretty soon.
You like this. You wanted them to use their own cash to buy stock, right?
Yes. We were talking about this recently, and we were talking about the ways that executives are paid, and I said pay them in cash. And when they think it's a good idea to buy stock, They'll go out there, they'll take their cash, they'll buy the stock. Immelt's doing that. He took his $2.6 million cash bonus and he bought GE stock. I like it. Good on you, Jeff.
Can I take the cynical view?
You can do whatever you want.
In the scheme of his net worth, this is like pennies for us. Maybe
it's not pennies.
Not pennies, but this isn't a sign that, well, it's better than him selling, I guess you could say.
It's better than him selling, and it's better than him just collecting options that the company gives to him. This is him taking cash. Think of all the wonderful things that 2.6, I don't care what your net worth is, $2.6 million buys a lot of champagne and limos and private plane rides and all that kind of stuff.
I'm just saying, put
Instead,
it into
buying
perspective.
GE stock.
His net worth is upwards of $100 million. So this
okay,
isn't
so let's say
thing.
it's a couple $100 million for somebody with a $500,000 net worth. That's similar to putting
like $1,000.
No, tens of thousands of dollars.
Maybe.
That's not an insignificant amount.
Does this put GE more on your radar? We saw Warren Buffett up his stake, or Berkshire Hathaway up their stake in GE. Are you interested in this business, or is it just one that doesn't get you too excited?
I don't know. That's actually a good question. I haven't looked at it recently. I think from a very general perspective, yes, because the GE Capital business isn't a bad one. I don't think it's appropriate that a financer of that size is tied in with GE because it kind of distracts from the rest of the business. But the core GE business itself, I think, it's a good business. It's a solid business. So maybe that's one that I need to look closer at. But Immelt certainly has rung the bell here.
We don't want to look at past performance too much, but this stock has basically been a huge underperformer.
That's actually
coming out of the recession.
That's actually a reason that I'd look at it even more. I'd rather look at a stock that hasn't performed, that everybody's left behind, and that they'll have that reaction, that they'll look at that chart and say, why would I want to invest in this stock? It's done nothing but go down.
True.
Then I go in and I say, boom, just like Immelt.
Just like Warren.
Yeah, just like Warren and Immelt. And speaking of, Warren invested in GE.
Personally?
Well, not personally.
Yeah, I said Berkshire.
Berkshire. Oh, you did?
Yeah.
I don't listen to you.
You zone out.
All right, going on to the focus for today. On Wednesdays now, we're using our focus time to kind of talk through some more basic concepts. Today we were talking a little bit in the headlines about Moelis, its IPO. So I thought we'd break apart what it means to be a commercial bank versus an investment bank versus one of these hybrids that kind of does it all.
Yeah. So
David, since you were talking about you like the investment bank model, why don't you break down a little bit what it means to be an investment bank?
So the word investment bank, since the financial crisis, has been a little bit scary, and we've got a graphic here to kind of break out those three buckets there. So on the just investment banks, talking about the Evercores, the Greenhills, Lazard, they're not that complex of companies. They're really more of consulting companies, if you want to think about them that way. Most of their revenue is going to come from advising on transactions. Some of them do have trading and investing operations, but the majority of the business here is looking at M&A, looking at buyouts, and giving their advisory services there, and they get fees for that. So it's not that complex of a business. When it comes down to valuing them, you want to look at it kind of from an earnings perspective, an operating business, and try to value that. It can be hard, because these things can be very cyclical, and you can't just say, well, they made $100 million this year, and that'll grow at 5% for 10 years. It doesn't work that way.
That would be a big mistake.
But in terms of valuing financial companies, this is one that you want to look at earnings more than kind of return on assets.
Or book value, yeah.
Exactly. So this is, in the scheme of valuing, this one ties more closely to kind of to the price to earnings valuation model here. So think about it as a fee business first. Is that fair?
Sure, and a couple things that I'd add to it. Management is a big deal at an investment bank. I would say that in terms of judging the success and judging the presence of the bank, most of these banks on their website will have a list of past pending transactions, transactions that they're working on. That's a good signal of, does this bank get good deals done? And then brand. Brand is a big thing. In this business, brand will get bankers in the door. And you actually, you had Goldman Sachs and Morgan Stanley in with the integrated, so we'll hit that in a little bit. But I think those are really a little bit more in the investment bank, but we can debate that in a second.
Well, I had them on there more because of their asset base, because they generate a lot of returns from the assets and they do have the advising, but they're in so many other businesses. So
That's fair. That's fair. So commercial banks, to hit on that real quickly, this is the more simple banking business. Commercial banks, and again, we've got this up on this chart, Capital One, U.S. Bancorp, Fifth Third, M&T, Huntington. These are good examples of more pure commercial banks. Take in deposits, have those deposits on the balance sheet, lend them out, whether it be to residential, for residential real estate, for companies to finance themselves, and in some cases buy securities, buy mortgage-backed securities.
And then offer other services, fee-based services. And we should say, a lot of those companies do have small investment banking arms, like U.S. Bancorp. They have a small, very, very small investment banking team for specific needs, but on the whole, it's just a
kind of
bank.
de minimis in terms of its. And so these businesses, you are going to want to look at the return on assets. You are going to want to be looking at the return on equity, and the valuation is going to be on a book value basis.
Yeah.
Management here, and maybe I should just say management is really important everywhere, but management here is important. You're going to want to look at loan quality. That's going to be a key metric here with the commercial banks.
Yes.
What are their, well, it's loan quality combined with what they make on the loans. Because again, if you look at the loan losses on a credit card portfolio, it's going to be different than if you look at loan losses on highly collateralized real estate lending. So that's the commercial. And then you've got the integrated, which kind of brings everything together. So tell me why Goldman Sachs and Morgan Stanley, we can look at that chart one more time. So again, we've got Morgan Stanley, Goldman Sachs, JP Morgan, Citigroup, Bank of America, all part of this integrated group.
Well, looking at Goldman Sachs, and more so Goldman Sachs is more integrated than a Morgan Stanley, I think, because Goldman Sachs, they do have a big kind of, they call it their investing and lending arm, which is them making investments, private investments, et cetera. It's somewhat of a black box. If you're going to call Goldman Sachs a black box, you're going to be looking at that investing and lending. They do have their M&A advisory, they have their fixed income trading, their underwriting, so they span the whole globe of finance a little bit, investment banking. Really. So that's why I threw them into the integrated. And when you talk about valuing these integrated companies, this is when it's more important to break it into kind of a sum of parts. Because you can look at the advising business and say, all right, how am I going to value that? And then you can look at the kind of corporate banking model and say, all right, this is the multiple on the book that I'm going to give. So it's more important to break these into parts here.
Right, and one area that we haven't even talked about yet, which is a discussion for another time, but there's also the asset management. Asset management, for the integrateds, you've got some of that with the commercial banks too. In some cases, you actually also have that with the investment banks. But the asset management in Bank of America with Merrill Lynch, that's very important. At Morgan Stanley, that's very important. And so this is another different line that you need to break out and be able to value. But I think I do agree with you that in terms of calling Morgan Stanley or Goldman Sachs, putting them into one of these buckets, integrated makes the most sense, because in the investment banking bucket, we really do have more of that advisory and capital raising business. Once you add in the trading operations, you add in the big exposure to asset management, Morgan Stanley and Goldman Sachs really do encompass a lot more.
I think maybe the way to think about it is they take on more risk on their balance sheet than kind of the
that's fair.
The Green Hills of the world. Goldman Sachs will take on a lot of risk for companies.
So you've got basically three different groups here, all of which call themselves banks of some sort. But for investors, it's really important to understand exactly what that bank means, what bank means in that case, how to value it, how to think about the business. And hopefully that gives a little bit of a basic overview.
Cool.
From there, let's go to the mailbag. We've got an email address, wtmi@fool.com. Please, 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 please send us an email. We love to get emails. We've got a question today from Joe Begley. Joe writes, I'm a junior at the University of Vermont, double majoring in Chinese and economics. That's aggressive. Good for you, Joe. In my intermediate micro class, we're talking about how low interest rates and low confidence are resulting in banks pumping money into the stock market. My econ professor believes that because they're not lending, they believe the stock market is a better place to make money than making loans. I was wondering if you could elaborate on this a bit. Do you believe this is happening? And if you do, are you at all concerned? Do you think that when they pull their money out of the market to make more loans to the market, the market will take a hit? Thanks for the question, Joe. Like I said, we love getting emails. David, do you see this happening? Because I don't.
I do not either.
Okay.
I don't.
So maybe Joe's economics professor is looking at something different than we are, looking someplace different than we are. But you can very easily go into the filings for the banks and take a look at the balance sheets, take a look at where their capital is. And where Joe's economics professor is definitely right is that banks aren't making a lot of loans. And you can see that in the loan to deposit ratio. So when the market gets really heated, you'll start to see banks hitting a loan to deposit ratio of 100% or even more.
Yeah.
So they're basically taking all of their deposits, lending them out, and in some cases then some, which means they're getting funding from other sources as well. Right now, those loan to deposit ratios, I want to say they're in the 70s and even 60s. I forget the exact numbers off the top of my head, but in that range. But the excess money, it's not going into the stock market.
Right.
These banks do own some stocks, but a lot of that's through asset management. Right. It's essentially nothing. If they do to any significant degree, it's through the asset management arms. What they are doing is they're going into the debt markets, they're going into the asset-backed securities markets, and they're putting money there, which is, I guess, sort of like investing elsewhere, but sort of not like investing elsewhere, because in the asset-backed security market, you've got mortgage-backed securities, you've got collateralized securities that are backed by credit card loans and the like. So basically what they're doing is they're using that as a way to stay more liquid.
Yeah.
I think when the economy starts to turn back around, when the economy picks up a little bit more, when there's more lending demand, and especially when there are better interest rates, when banks are better compensated for the risk that they take for lending, I think we'll see them actually do more lending, maybe increase that loan to deposit ratio. For now, I think this is a way for them to maintain a greater amount of liquidity.
Yep, because it's really easy to sell a U.S. Treasury or a agency mortgage-backed security, right?
Right, and you can
As
also
opposed to a loan, which is kind of
you can also manage your duration a lot better. So whereas a loan, I mean, for a really simple case, if you just take a vanilla 30-year mortgage and put it on your balance sheet, you've got that on your balance sheet for 30 years. Banks don't normally do a whole lot of that. Whereas with a mortgage-backed security, you've got your pick of what kind of duration you want. And so you can have a duration of 1-2 years if you want this to fall off your balance sheet in a shorter period of time.
I'm glad you mentioned the asset management. We talked about 13 Fs for hedge funds and stuff like that. If you type in a Bank of America 13F and you look at it, it'll look huge. It'll look like they own every stock in the world, and it looks like their equity portfolio is enormous. But the way the asset managers work, that's really client money that is invested in those. It's not the bank's capital that's sitting in all those stocks. It's the way the filings work. They have to say like what their what's the term? They're kind of a custodian for those clients there. They're investing on behalf of them.
It's in their name. It's in Bank of America's name, but it's client money.
Exactly. So don't think that that's all Bank of America capital sitting in those stocks.
All right, let's move on to our Rank It segment. We've got a fun version of Rank It today. This is inspired by the fact that we just, it's Oscar season. We just passed the Oscars this past weekend. And so we are ranking, going back the last 10 years, ranking the best picture winners over the last 10 years.
Top 5.
Top 5. David, what is your list?
Here's my list. Going number 1, Hurt Locker. Number 2, The Departed. Number 3, Argo. Number 4, No Country for Old Men. Number 5, Slumdog Millionaire.
The Departed at number 2, really?
It's a good movie.
It is a good movie.
It's entertaining.
Okay, let's put up my list real quick. I've got Slumdog Millionaire as number 1, Hurt Locker is number 2, 12 Years a Slave number 3, $1 Million Baby number 4, and King's Speech number 5. I was debating as to whether I put the artist up there because I give
What?
Look! Don't give me that. I give them so much credit for making such an enjoyable movie under the constraints that they put on themselves, but at the same time,
was it enjoyable?
Yes.
I watched the last like 30 minutes. I was like,
really, you did not enjoy The Artist.
No.
You're dead.
I only watched the last 30
inside,
minutes.
aren't you?
It didn't make any sense.
You're dead inside.
No Country for Old Men for you?
It was good. It was
that
good.
haircut? I'm thinking about getting that haircut that Javier Bardem has.
Maybe I have to watch it again. Maybe I missed something.
It's a good movie.
But how do you judge what movies you would put in a list like that?
2 ways. 1, if it makes me want to go research it more. 2, if it's on TBS. If it's on TBS, I watch it.
If it's on TBS?
Yeah. You know when they have the old reruns? If The Departed is on, I'm watching it. What about you? How do you judge it?
When a movie creates emotion without being schlocky. So I mean, a Kate Hudson ro-com can make you feel something on the inside, but that's because those writers are like, haha, we're gonna tweak them. But when a movie creates emotion without going there, I think that's a great movie. Slumdog Millionaire blew me away. Just so, I thought it was so original. I thought it was so out of the box.
Cried.
I laughed, I cried, I ate probably too much popcorn. I have a popcorn problem. Let's go ahead and quickly tie this in, give it a little bit of a business flavor here. Over those 10, I went through and I looked at the distributors, the distribution deals over those 10. 2 of them had 21st Century Fox doing distribution, 4 of them Time Warner, 2 of them Lionsgate, 2 Weinstein, 1 Viacom. So if you're looking for a winner in terms of the distributors, the movie distributors over the last 10 years for Best Picture, Time Warner looking pretty good.
What was 12 Years a Slave? Do you know?
I didn't break them out for each one. Lionsgate, I think it was, no, Lionsgate was the studio actually.
Gotcha.
So that wasn't captured in here. I'm pretty sure Lionsgate was a studio, Summit Entertainment, which is the Lionsgate subsidiary.
All right.
All right, what do we have next?
Twitter.
Twitter, yeah. So I was so busy thinking about these great movies. Finish us off, David, Twitter sphere. Number 1.
From Market Watch, Carl Icahn says, even Washington, D.C. operates better than eBay. He says this is the worst corporate governance he's ever seen. My question is, why is he buying it then?
Carl Icahn is a good investor. He's even better at hyperbole.
Why isn't he shorting it if he hates it so much? I don't get it.
Because he wants PayPal. He wants the PayPal. The people demand the PayPal.
The people want the PayPal.
Second tweet. This comes from Balaji S. Srinivasan. I know I got that wrong. I'm so sorry. David, I hate you for doing that to me. It is usually much easier to save $1 in costs than to make $1 in sales. Wow, interesting comment given what we've seen with the banks lately, what we've been talking about with the banks. It's all about cost cutting. Think he's right?
I was thinking more from a personal perspective.
Oh,
Everyone wants to make money investing, but we've had Morgan Housel on before. He says the biggest problem is people not saving enough. It's not about market-beating returns. It's about not saving enough.
David, I've eaten peanut butter and jelly every day for lunch for the last 10 years.
Yeah, it's not you.
I've calculated that my lunch costs less than $2.
Frugal.
You've
probably made more from doing that than you have investing.
Maybe. I don't know. We'll see.
Maybe.
I'd hope that I made a decent amount of investing. All right, finish this off. Last tweet.
It's from Huffington Post. It says, "So college." We have a picture of a coffee machine filled with water and someone making pasta in the coffee machine. Did you ever do this in college?
I did not ever do that.
Most despicable kitchen thing you did in college or ever?
Well, when I lived in a frat house for a very short period of time.
A lot of despicable things.
We did not have a kitchen, but there were times when there would be, a half-eaten burrito sitting around and not entirely clear how long it had been sitting around. And, I wasn't a biology major, but I could see if mold was growing on it.
Probably.
How about you?
I lived in Spain for several months, and our sink did not have a garbage disposal.
Ooh.
Let's just say it got backed up, had to bring the plunger in there to take care of things.
I think I've been there.
Took the plunger to the sink.
Pretty sure I've been there.
That's despicable.
All right, well, that's our show for today. You can find us on Twitter at TMF Financials. If you're not listening to us on podcast form, we're on iTunes. Go find us on iTunes. Find us on Swell. Find us on Stitcher. And you can also rate us on iTunes and let everybody know why they should be watching this show. I'm Matt Koppenheffer. This year's David Hanson. We will see you tomorrow.
People on the show may have interests in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.